All right, guys, stay tuned while I double check my systems here. Bear with me. All right, I think we are good to go. Okay, so I show we are live. So I will jump in. Welcome to the stream. So as the title says, I am short SPY and I'm looking at undervalued stocks. Here we have the S&P 500. And I've got a nice colorful chart. And if it were cheap, it would be closer to this purple stuff. This is great when I'm looking at other stocks. It just kind of automatically points out bargain stocks. Like one of the bargain stocks I'm going to talk about is IQ. And look how low that is. This yellow is the 200-day moving average. We're below that. That's always a good sign. We're deeply oversold. We are more than 80% below all-time highs, which is 40 bucks. If we look at the SPY, the SPY ETF, it is above the 200-day moving averages. I put on some SPY spreads, some bear spreads on SPY. And not only is the chart saying it's expensive, the valuations are as well. And that's a key lesson for me. Trading with valuation is hugely important for me. Huge, huge, huge. And what does that mean? It means if you were buying a business, what would you want? You're going to want three things, let's say. Healthy earnings, like if you were buying a rental property or a laundromat, you're going to want cash flow. Healthy earnings, cash flow. You're going to want those to be growing, so growth, and then capital efficiency. You might also want a moat, but those can be packaged into the other three. But capital efficiency applies more to individual stocks. Earnings, healthy earnings and growth applies to the S&P. So, yeah. Let's look at S&P 500 multiple earnings yield. There's this great website that I like to look at, multiple.com, multpl, multiple.com. And let's see. So they show the PE ratio over time. And this is just the normal PE ratio. Sometimes this can be misleading. But it's hugely important. So S&P 500 PE ratio, you take the price and you divide it by earnings. So I pay this much and I get this much, whatever that ratio is. Right now, it's at 30. What that means is if the current price is, what is it? On the SPY, it's 593. It's almost $600. And you're going to get 1/30th in earnings. 1/30th. Whatever the earnings is, you're going to pay 30 times. You're paying 30 years of earnings. So you'll get all your money back in 30 years for this year's earnings if they don't grow. 30 years of earnings is what a 30 PE means. 30 years of this year's earnings. If the earnings really grow in the future, then that ratio changes. And that's why people pay a lot for growth stocks. In 1980, the PE ratio was only 6. And there was a lot of things going on in 1980 that would justify fear. And that's usually why stocks get cheap. But the PE ratio, let's round it up. Let's say it was 7. That means it only took 7 years to get your money back. That means you would break even, get all your money back in earnings. And then going forward, it was pure profit. That's how you think of it from a business standpoint. We would want to get as much value as possible, wouldn't we? Let's zoom in on a 20-year. I think most people by now were trading around 2021, and if you look in 2021, the PE ratio, according to this, went almost to 40, and a lot of stocks fell from that period. I mean, even worse than the S&P. So whatever, if you were buying individual stocks, that was a good time to get out of them because there was a mini bubble. And almost everything went down until 2022. And then as if you remember, AI exploded because of ChatGPT. But that level of valuation was 20. In reality, the forward yield on the S&P was closer to 16. And 16 is important. The median and mean PE ratio for the S&P is 16. So if you see a decline in the market and you see the PE of the S&P 500 below 16 or 15, you might start doing more research and you would be more eager to buy. Right now it's twice that level. We are twice the historical median PE. So buying at 15 and 16 PE on average is fair, and we are twice that fair PE. So that's one of the reasons why I'm eager to be bearish on the S&P. This is the S&P right here. But I'm not bearish on all the stocks. And that's the next part that I want to talk about, which is my list of quality names. This is my list of stocks that are cheap relative to their future and stocks that are just cheap today. And this list is a living list. It's a living worksheet. It generates every day based on all the data below. So I have at least, I forget if it's 50 growth stocks. If you look at the growth ETF, SPY-G ETF holdings, I've already included those growing names in my list. Let's just pick a listing of the growth names. If you look at these growth ETFs, you can get all this information and then you can analyze it, which is what I did. So if we go to my list, I have not only the S&P 500, not only the Mag 7, which is Microsoft, Meta, Apple, Amazon, Google, Tesla, Nvidia, but I also have, I think I have, what is this? 54, the top 50 growth stocks, which is typically the largest growth stocks. That doesn't mean they're the best. And not only that, I have international stocks and a bunch of stocks that I found interesting and attractive. And then my worksheet scans through them. It actually goes line by line and it figures out what are the most attractive names. And I use that using this function here, which is a filter and a sort. And if you haven't, I just learned how to do this and I think it's awesome. I definitely think it's awesome. I recommend it. I've sorted it by my specific parameters, but according to my parameters, there's, 17 stocks out of the almost 200 that I look at. 17 stocks that are worth looking at and that are better than the rest. I don't think they're all fantastic, but this is a great place to start. So I'm going to go over those 17 stocks. I might not choose them all, but what I look at is price, enterprise value, which factors out the debt. I figure out some formula for potential earnings or potential return. I look at the earnings yield, which is their earnings divided by price. I look for the earnings yield for next year and this year. I have a formula for intrinsic value. I have a future 5-year price using only 20 PE. And then I have whatever the growth rate times 2. I use that as a growth multiple. That's a Peter Lynch concept. And I figure out a future price. I also figure out the future price divided by the current price to figure out an X bag. Like how much can it grow? And how many bagger is the stock? For example, JFIN here, the first one. And these are sorted by earnings yield because earnings don't lie. Well, they kind of do, but earnings are today. Today's earnings are more important than the future earnings. That's why I do it this way. And their PE is so low. I think it's like it's close to 2. So that gives it a hugely high earnings yield of 47%. That means the company is earning 47% relative to the stock price. And they must have more cash than debt because their enterprise value is lower than the stock price. So let's just look at that one. I don't recommend it. I know it's a lending company in China. There's a lot of risk. In the past, what is this? In the past 2 years, it's moved huge. As much as, what is that? 289% gain in the past 2 years. So it was $1.70. Is that a quadruple? That's more than a quadruple. So that's JFIN. And look, their tangible book value. I have a level here for tangible book value. It's below that. So they are still, on a book value basis, undervalued. That's the weekly chart. I'll look at the daily chart. Let me check something real quick. Okay. Yeah, so if you just look at the fundamentals, JFIN would be attractive. I still want to buy it on a dip. So a dip is anything below the 200-day moving average. Okay, so a lot of people are asking about IQ, so I'm just going to jump into IQ. IQ stock is $2 again. They have a little bit of debt, so their enterprise value is above the stock price. The CAGR potential, according to my worksheet, is 51%. So that means, I mean, that's fantastic. That means holding it for 5 years should give you 51% per year. The earnings yield is 12.5 this year, expected to be 16% next year, which is fantastic. It's also supposed to be a high grower, and they're very capital efficient. Intrinsic value, according to my worksheet, is 26. At a 20 PE, which is not that high, the stock in the next 5 years could be $16. And if you use their growth rate times 2, it could be worth close to $40. Let's go look at the chart. Now, we defined a dip as anything below 200-day moving average, and we are way below that. What's it doing now? IQ is up almost 2% today. So anything in this purple zone is supposed to be beaten up relative to the longer term moving averages, and that's definitely a time to get interested in buying. I can't say buy, and I can't tell you to buy, because that would be advice, and I can't give anyone advice. I'm not your financial advisor, and I'm not a financial advisor. I'm just a trader, an investor. So look at the difference. So if we go back to the S&P, above the 200-day, already had a bad day last week after the Fed said it's not going to cut as much. And what is the earnings yield on the S&P? Let's compare. So the S&P earnings yield is 4% this year. So if you're happy making 4% on your money, and that 4% can grow, then this might be for you, right? It's diversified and you can hold for a long time. Problem with that is, historically, that's not been a fantastic return. Okay, but that, I don't want to dive into that, but let's do it anyway. Let's see. I'm going to try to find the earnings yield. The S&P earnings yield. All right, here we go. So I showed PE before. Now I'm going to show earnings yield. If you look historically, the S&P 500 earnings yield has been low, 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 lower. That's been a wimpy yield. And it's spiked up high, high, high a few times. That's over 10%. So there are times when the S&P yields over 10%. There are times when it yields less than 3. So what is the median? Just like PE, the PE of 15 to 16 being the average, the median and mean yield is close to 7%, which makes sense. Here they define the earnings yield. Earnings yield, trailing 12 months earnings divided by the index price. So this S&P 500 is yielding 3.3%, and historically it's supposed to yield 7. That's the average. So what does that tell you? Wimpy yield, risky yield. They're pricing in a lot of growth. If they're wrong, it goes on sale. given that the yield is at 7, all we got to do is go to the S&P divided by 2. That's 300. If the S&P ever drops anywhere near 300, which is way down below, even below 2022, 2023, well, you should buy it, at least historically. And that's if you want to make 4%. 10-year. The 10-year is at 4.5%. So if you are happy making 4% or 4.2%, you should be really happy buying bonds, treasury bonds, at 4.59%. Historically, if you can get a better return on treasuries, you should take that. And that's called the risk premium. If you can get more from stocks, more earnings yield, you should take that. But if you can't, you get bonds. So right now, people should be buying short-term bonds, probably short-term bonds, and taking that money, or looking for bargain stocks like I'm doing. And this is risky. It's still volatile, but this is gonna outperform, at least in theory, over time. Last time I went big into IQ, the stock went from, let's say, $2 to $3.29. That was a 65% move. I traded it also when it was higher in the 3s, and it shot up to 5 and change. Full disclosure, I am long IQ and Baidu. IQ in a big way, and I'm using calls and call options. Same thing with Baidu. I'll cover Baidu, but this is the one that I'm very excited. So what is this? EPS trailing 12. Yeah, that makes sense. So this is the earnings for IQ. Their peak earnings was that 28 cents? This is the trailing 12, so the last 12 months. So they're dipping a little bit, and that's why the stock came down so much in the last couple months. Their best quarter historically seems to be in the winter quarter. So think December, January, February. That's when they get the most advertising revenue. They should be getting revenue now, and Chinese New Year. So IQ is a streaming business. Let's look at it. It's been compared to the Netflix of China. And they actually, you can get the app here in the United States. So if you wanted to get this content, you could get it. Just download the app and you could see all of this content. Now they have premium content and free content. And I believe they have something like let's ask AI. IQiyi, tell me about its users and paid members. So this is IQiyi, IQ stock. IQiyi, often referred to as the Chinese Netflix, is one of the largest online video platforms in China. As of the end of 2023, IQiyi had reached nearly 112 million daily average subscribing members. That's paying members. This substantial user base highlights the platform's popularity and market penetration. That's another thing we should look up. IQiyi boasts an impressive reach with over 500 million monthly active users. The platform's content is highly engaging, with users spending nearly 6 billion hours. Okay. Tell me about Chinese online streaming market share. largest companies. All right, so TikTok, the parent company of TikTok, is Tencent. Tencent Video is the largest player with 110 million households, market share of 22%. A close second is IQiyi, which is, I think, 40 something percent owned by Baidu, with 102 million households, 19 to 22%. So IQ is the number 2 player, you can say. Youku is Alibaba, they're third. Mango TV is fourth, and then Yang Shippen is fifth. So Alibaba is another good candidate for a value purchase. All right, so IQiyi stock is down. Last earnings call, the managers said their programming wasn't so hot. What can you tell me about this? IQiyi stock has indeed been struggling recently. The company's stock price has decreased 55% in the past year. It's been attributed to several factors, including challenges in their content strategy and financial performance. Regarding the management's comments about their programming not being so hot, now those are my words, this aligns with the challenges faced by streaming platforms in consistently producing hit content. The quality and appeal of content are crucial factors in attracting and retaining subscribers in the highly competitive streaming market. If IQiyi's recent programming has not been meeting audience expectations, it could explain the decline in revenue and stock performance. They did talk about that in the last earnings call, so it may not have the text. So I think maybe they were holding back. China is in a real estate bubble deflation, so that's hurting the market. Tell me about China's property downturn. Are they in a real estate depression? Now, depression sounds like a really bad word, but it just means slow down below normal. China is indeed experiencing a severe property downturn that has been ongoing since 2021, with many indicators suggesting that the country is facing a real estate depression. Wow, can't believe they're admitting that. It seems like such a heavy word to admit. The situation has significantly impacted China's economy and consumer confidence. The extent. New home prices have fallen for 16 consecutive months. That's a year and a half. In the USA, when property topped out in 2006, it didn't fully bottom until 2011. That was 5 years. And there was a huge speculation bubble in China. Home sales measured by floor space have decreased by about 50% from 2021 levels. So they're selling less footage. Like, they're not shrinking, but they're just selling less volume. The value of new homes sold dropped by over 23% through August 2024. That's big for real estate. The property sector once accounted for around 25% of China's GDP. I mean, that makes sense because, homes are where the jobs sleep. Speculation, building. I'm surprised it's only 25%, but China is a big manufacturing country. So home prices are expected to fall 6 to 8% in 2024 this year, and an additional 4.6% in 2025 next year. So they're not done going down. I know they're trying to stimulate, because when IQ stock was shooting up 60%. It was on that stimulus potential. Okay, so IQ is one I'm definitely looking at. It's now up 2.44%. And I wonder if I can look up the calls. Sometimes it lets me, sometimes it won't. But IQ calls must be going up. I'm hoping this whole thing will be a double bottom. This is some kind of the V of the double bottom. So it would be, here's the V, so it'd be boom, boom, something like that. I've already drawn that. Okay. So that's that. How high can it go? We've already spoken about that. Let me show this cool feature that I started doing. So that looks noisy, but if you, let's go to like a 2-week chart. So I've already drawn out levels of what it should be worth if those earnings pan out the way they're expected to by analysts. If this is AI helped me make this, or I plugged in the earnings and then projected them out and then plotted a 25 PE price. So it should be, IQ should be worth $6 easily. Next year, $8. Now, worth and trading price are different things, but the intrinsic value, which is the financial value of a stock, that's what I'm looking at. 2027, $12. And then I drew those out here to kind of give me a guide. What I want to do is hold this stock for a few years or as many as needed, because if this company is still growing, you're still making money as an investor. But imagine buying in this 2 level. It goes up, it goes up, it goes up. It keeps earning. What should it be worth? Well, that's what this table is meant to do. If you hold this forever, well, that's what Warren Buffett does. He holds them forever. One day, could this be worth over $300 a share? Well, it depends if the company keeps growing. Is that sustainable? Could it be because of money devaluation? Who knows? But for me, generally 2 to 5 years, I usually get a good trade out of a deep value stock. So I just know that I need to hold 2 to 5 years, and something good will happen along the way. Let's go over to Baidu real quick. Now, is Baidu on my list? So Baidu is not on my list. Baidu is not on my 40% CAGR list. So I can't really dive into that too long right now. And let's find out why. Baidu is here. So Baidu is just below 40. So I'm just gonna tweak this. So it says 39. I'm gonna make it 38 so I can get Baidu. So now Baidu is on my list because 39% CAGR is good enough for me. It's at 38.5. So Baidu future price, best price in 5 years, $467. It's trading at $88. They have more cash than debt, so it's really worth $69. You subtract the cash. 5-year future price, almost $500, 5x. 5x your money. That's what Apple did. If you bought Apple in 2008, it went up 8x in 8 years and 64 times your money in 16 years. So 5x in 5 years is fantastic. The earnings yield on Baidu is 12.1, and the next year is 12.5. So it's a value stock. You have to look at Baidu if you're looking at IQ, because Baidu owns a big chunk of IQ. So let's get a new thread. Tell me about Baidu's revenue streams. So Baidu is, let's go to a weekly. I know it's a mess, but I'm not gonna change it. Baidu used to be $343 a share. Now, multiple times. Let me take some of this off. Multiple times, Baidu has hit below $100 and then rallied up. It did it once before, recently, when they announced the stimulus. It went from $82, $81 to $113, which is a 200-day moving average right there. I think it's going to do the same thing as what IQ is going to do, some kind of a double bottom, hit 115, maybe higher, because it's worth it fundamentally. Yeah, so I'm expecting this to be more than $100 stock, potentially even over 300, and then over 5 years, $500, because these earnings are juicy. They're earning $8 right now in a real estate depression. In a real estate depression in China, the most they've earned is $20. So it's important to look at the peak earnings of a stock and then recognize that they could potentially earn that. And we need to figure out, if they can earn it again, that makes the stock attractive. What would the stock be worth if they made $20 a share? Well, at least a 20 multiple. So 20 times 20 is 400. All right, let's go back to the AI. Tell me about Baidu's revenue streams. Baidu, China's leading search engine, numero uno, has diversified revenue streams that contribute to its financial success. The company's business model is designed to ensure stable income while fostering sustainable growth. Okay. Online marketing services. So ads. So their number one search engine. So it's just like the Google of China. AI and cloud services. So this is an AI play. Company monetizes its AI cloud services by offering businesses subscription-based cloud computing and AI solutions. Oof, that's hard to say. The segment has been growing as more enterprises seek to enhance their operations through advanced technologies. So here's the IQiyi part. Baidu's IQiyi segment, often referred to as the Netflix of China, generates revenue through content subscription and online marketing. Oh, okay. So they do AI products and services. Baidu's conversational AI, Duer OS, I can't say that, smart devices, Xiaodu smart devices contribute to revenue through product sales and integrated service offerings. Autonomous driving. While still in development, autonomous driving technology represents a growing revenue stream with significant future potential. That's going to be like a Hail Mary, especially right now. Robo-taxis and autonomous driving is just sucking up capital for most businesses. Revenue breakdown. So the core business is 11 billion total revenue, 76% of total revenue from probably search and video. And then IQiyi is 20% of their total revenue. So you have to look at both together, because if you really like IQiyi, there's a big chunk of it inside Baidu, and they support each other. So let's see. How does Baidu help IQiyi traffic and search leads? Let's just do it like that. Baidu, as the parent company and leading search engine in China, provides significant support to IQiyi in terms of traffic generation and search optimization. This collaboration enhances IQiyi's visibility and user acquisition. So it's great that they're partners, because Baidu is going to push traffic or make it easy to find IQiyi. All right, enough about that. If you have questions, leave them in the comments on those stocks. Let me just, okay, let's just quickly run through the remainder of like bargains. Let me look at PDD real quick, just where it is price-wise. Yikes, I don't know what. I know PDD is a bargain, but the chart can go either way. Like financially, it's a bargain. $10 in earnings on a $100 stock, that's a 10 yield. So that's a tricky one. I could see it falling, but I could see it also being a bargain. I think most Chinese stocks, if they're earning well, are a bargain. Something not in China. Let's look at Yalla is a really tiny one. So Yalla has a ton of cash on their balance sheet. They're a video game company in the Middle East. $5 tangible book, and they make 80 cents a share. It's a screaming bargain when you factor out the cash. Stone, those have been beaten up. Stone and Pags still getting beaten up. Let me look up, why is Stone stock falling? Stone ticker. Is it inflation or rates in Brazil? It's just easier to do it this way. Declining market share, rising cost, Brazilian economic factors, interest rate hikes, slower growth, market volatility. Okay. So those are weighing on Stone. Let me just see what any updates on Stone. Some debt, some cash. I'm trying to look at the earnings. $1.12, $1.29. Let me look at my system. $1.12, $1.39. Let me just update this. $1.48. Let me see if that changes. Nope, Stone is still a great value even with reduced earnings expectations. So Stone is a potential 14 bagger. So I like it still. It's getting beat up. Rarely does it go into the purple. It's down more than 50% from the short-term highs, and this is like what, 90%, 91%. Ugh, what a mess. I'm long that. Okay. Where is CSIQ, Canadian Solar? Okay, Canadian Solar also below the 200-day moving average. I still like this. They have a ton of tangible book value. They hold. They're losing this year, 2024. They're at 10 PE. They're making $1 and then $2. So they're cheap over the next 2 years. Solar is down. There's tariffs on China. They're building plants in the United States. So where is TAN ETF? TAN ETF is getting decimated, but now looks attractive. First Solar, which is a U.S. solar manufacturer, that looks attractive. Wow. So First Solar, huge growth. Wow. Is that real? Huge growth expected. Low PE stock. What's the problem with this? Is there any problem? They have 600 million in debt, 1.2 billion in cash, a little more cash than debt. Wow. Why is that not on my list? Let's go at it. So this is how I add a stock to my database. I need to find the earnings. $13.24, $21.03, $13.24, $21.03, $29.49, 33. So you can make a worksheet like this yourself, track your favorite stocks. You just got to keep updating the numbers as they come. 34 something, 34, and lastly 35.74. So once you find a bargain, you still have to dig in and do the work, make sure those earnings are good. I'm just going to do the same for EV. And then I have a bunch of formulas that do all the work for me. This one doesn't seem right. Is that right? So they have a bunch of growth and then they slow down. That must not be, well, I'm going to leave it just like that. And First Solar has a 32% CAGR. So it's attractive, but not screaming value. Okay. Anything else that I want to cover? SMCI, let's just do quickly. SMCI was screaming value. It still is. Maybe this is going to be some kind of a shoot up like that. This is like an inverse head and shoulders, maybe. First, or SMCI, 10% yield now, 13% expected, as long as nothing bad happens after the whole scandal with their reporting. So I don't have a big position, but I have a position. That was just a mess. So SMCI went from $10 to 130 and then got decimated 83%. And now it's $32. So here, let's have AI talk to us. What does SMCI Super Micro do? How does it benefit or partner from NVIDIA AI trend? Super Micro, also known as Super Micro, is leading provider of high-performance, high-efficiency server technology and innovation. The company specializes in developing and delivering end-to-end green computing solutions for various markets, including AI, cloud computing, data centers, and edge computing. So Supermicro's main offerings are servers and workstations, storage systems, networking devices, server management software. So from my understanding is they build the whole racks and they install everything around the NVIDIA parts. Anyways, it was beat up. It's a way to participate in a value way. Their tangible book value was near too. Tangible book value, as in all the hard liquid assets on the books, 870. It went to $20, so it was getting real close to tangible book value. I think it goes back up to 100. That's why I'm in it. If I can get a triple out of it, I'm happy. Semiconductors are cyclical, so I do worry that there could be a slowdown. Where's NVIDIA right now? NVIDIA popped up. So there's going to be a Christmas rally, which means there's just not a lot of volatility over the last few days of December. There's not going to be a lot of volatility. They're just going to let them drift. So sell puts and everything, but be careful. Where's AMD? Is AMD on my list? It was on my list. Oh, but I had to drop. If I drop my Kager, AMD goes on my list. So if I'm looking for, yeah. So AMD is good, but it's just not great. They have a low earnings yield this year, a 4% next year, but they're growing at a high rate. So the idea is you're buying the growth, but it doesn't make it on my list. So let me go back to the 38. Stone, Yella, I'll ignore those. IQ, Momo's okay. PDD, SMCI, Baidu. I'm not going to cover Intel. Well, I guess I should. Intel is probably tradable, but it's not investable really, because they require so much capital that there are better business opportunities than Intel. It's just a mess at Intel. It's tradable but not investable. Let's put it that way. And I think that's all I want to cover. The whole point of this video was to cover valuation really, but a little bit of the SPY valuation. SPY valuation being the Mag 7 stocks. Let me just show that real quick. Most of the valuation from SPY is these 7 stocks. And they all have wimpy earnings yields. I mean, only Google has an attractive earnings yield. The rest look expensive. Now, if growth continues, they will grow. They will keep growing into the new future multiple at that growth rate. But as we've seen with Meta, if something scares investors, there's a big crash in the stock. So we want to be careful. Meta dropped 75% when there was a change in Apple's privacy rules. So we want to be careful. I think there will be a time when the S&P dips again. It might dip 10, 20%, 30%. I have no idea, but I don't want to be in heavy right here because what's my upside? My upside is limited. My downside is 50% historically. So if you like this or you have a question, you have a topic you want to cover, leave it in the comments and we will continue to chat. Happy holidays.